Welcome back to Markets Today. We are discussing the outlook for the Kenya banking sector and the key news that has come out. In other words, the breaking news for the financial sector today is the second quarter GDP numbers that have just come out. We've actually seen a contraction in the growth of the Kenyan economy for the period ending June 2020, and that's minus 5.7 percentage points. Now let's look at what is happening in the banking sector. Reginald has just joined us. Before we took the break, we were looking at the impact of the restructured loans, the impact that this could possibly have on revenue, and there's certainly an impact, a negative or rather downward impact on the revenue that could be booked on these loans that are restructured, and it's a similar trajectory when you're looking at the non-performing loans. Reginald, before we went for the break, you're just giving us an oversight of the banking sector and how to look at the revenue line. And I think you've brought us to the point of understanding and appreciating that you can't just focus on the restructure. If there's going to be a restructure, if for instance I was paying 100,000, if that becomes 50,000, the interest element reduces. Yes, the loan will be for a longer period or for whatever terms are, but in that particular period, the interest will, in one way or another, come down. Then you've walked us through the non-performing loans. Help us now understand the structure of the banking sector income statement. You're telling us there is a threat to revenue in one way or the other. Then what is happening to costs and what is happening to non-performing loans, and how should we look at the big picture when it comes to profitability for the sector?
So if I'll begin with non-performing loans, so if you look, if banks have restructured the amount that they've restructured close to 452 billion. If you just look at the top 7 banks, they've restructured combined 452 billion.
That's almost 20. That's okay. 20%. I think the total sector is about 27%.
Yes.
Okay.
And the main worry that comes with that is if there was no restructuring, which was pushed down by central bank, and if the banks were to strictly follow IFRS 9, this 452 billion would have been classified as non-performing loans. They will have to revert back to IFRS 9 at some point, whether it's before the end of the financial year.
Okay.
They cannot drop it completely. And another twist that brings is that asset pricing becomes very warped. How do I value a bank right now, which is restructured 120, which I know that this 120 is actually pretty much, in all intents and purposes, under IFRS 9, is actually supposed to have been categorized as a non-performing loan. So it disrupts the ability to actually value KCB, value ABSA, and actually value them in the right way, because they've literally broken every accounting convention by not classifying them the way they're supposed to be classified.
But also on top of that, when it comes to valuation, it's also a bit of a sticky spot right now, because again, the banks are not paying dividends or have cancelled dividends. So you can also use the dividend model as a way of figuring out price. I'll come back to that at the tail end when we're talking about valuation and does it make sense to buy the banks now. But let's continue the conversation on costs.
Yes. So if you then now come to your income statement, so we are saying that if you look at the balance sheet, the two main assets have pressure on them, and it's downward pressure. The benefit the banks will get in this period also is that the cost of funding will also reduce, because with a low interest rate environment, banks will get funding cheaper. Because that area of a bank's balance sheet, that's the liability side, is more sensitive to, it responds faster to drops in interest rate. So their interest expense will most probably come down. However, what I will be worried about is their non-interest expense. Most banks did not lay off people during this period because of fearing the labor court. Your bills remained the same, and the other costs that you normally have remained the same.
Technology, the cost of platforms, the buildings that you're using.
Exactly. So you find non-interest expenses pretty much remain the same or even just increased. So you have a top line, your interest income has reduced.
Okay.
Your non-funded pretty much remained the same, because your fees and commission is also dropped because of the directive of don't charge transactions to M-Pesa.
So that has dropped slightly?
Yeah, because if you look at most fees and commission for banks, it's actually mostly movement from my account to M-Pesa, which is now they were told, scrap that fee. So you'll realize either they will maintain because banks again are geniuses. They'll put costs
Oh, yes, they
somewhere
certainly
elsewhere. But ideally, the non-funded will not grow as much to compensate for the reduction in funded income.
So the way the bank earns money is, number one, you give out a loan and you earn. But
Yes.
now you've had to restructure a good chunk of these loans, meaning that the revenue you've been earning from that particular chunk is coming down. Then the second way that you earn is through more bank to mobile, bank kwa M-Pesa.
Non-funded income, yes.
Transactions, that's the
Forex
non-funded.
trading,
It's more or less flat with the possibility of going down.
Yes.
So your total revenue pool is not growing.
Yeah, it is actually contracted.
Then now you're coming to the expenses and you're telling us on the expense side, there are also two key expenses. There's the cost of your labor, because your people, staff are still working. If you have technological platforms, you're still paying for them in whatever way, or you're still servicing them. There's also the element of real estate. So there are all these major expenses that you still have to service in one way or the other. So that expense line is flat or slightly growing, depending on whether you had to adjust your prices over the year and how you engage with your suppliers. Then the other key line that you're saying in terms of expenses is the loan loss provisions. And that's a line that you're saying could possibly grow.
That one will definitely should grow.
Will it grow more faster than it grew by the end of June?
I expect it. They may not. It will be disastrous for them to grow it faster.
Okay.
Because if they grow it faster, then banks will have losses.
Exactly.
Not reduced. What we saw in Q2 was reduced profitability.
Okay.
If they make the same level of provisions they made in Q2, then all banks will go into losses. So most probably they will either do 25 or 30% extra on what they've already done, if they are to be fair. Because if you've restructured 120 billion and you're foreseeing yourself having to go back to IFRS 9, the question is, have the conditions that made you restructure, for example KCB, have the conditions that made you restructure this 120 changed?
Okay.
If you look at, again, most banks don't give you this information in their presentation. You need to be asking for is a breakdown of these loans. Which sectors are these loans in? So if you look at KCB, I know KCB gave that information. Majority of their restructured loans came from the personal space. And I'm thinking, if these are people who have lost jobs, they should ideally just write off that. Just classify them as non-performing or provide for them. If they are to do that, then their provisions are going to increase, so to speak. And once you put a loan loss provision, or you put your money in your provision account, it hits your profit at the end of the day. So apart from falling interest income, stagnating non-funded income, growing or same level of non-interest expense, and a slightly reduced interest expense, then you add the loan loss provision there. I do not see any bank growing their profits bigger than what they had even in Q2. So quarter on quarter, we will definitely see that we will have most probably a drop in profits, and year on year, definitely another drop as we come into quarter 3.
That's a tough season to be in, because on the flip side, you're actually seeing investors saying, okay, maybe the worst has happened, and we feel that the bank valuations reflect value in the future. But now what you're telling us that come the end of the year, this situation that we have seen for the numbers that came out in June, with banks such as KCB reporting 39% drop, could still continue. Maybe not by the same magnitude, it could still continue. And then the second thing that you're telling us, the earnings pool, which is the pool that you expect to be paid a dividend as a shareholder, doesn't look like it's going to increase. And also at the starting of the show, you've talked to us about GDP. So it looks like this earning pool is shrinking. And we're also, as an economy, we're going into a political cycle. Should I be buying these banks now?
If you're buying for long term,
what is long term?
Long term being way post 2022 elections.
Is that 2030?
Yeah. Ideally, to an investor who invests on fundamentals of the company, then it will definitely be a bit worried, because everything does not point to good profitability or good dividends this year, no next year. So if you look at sectors like tourism, accommodation, food, restaurant, personal loans, and all these other things, they don't look like they'll recover to 100% by end of next year. They might recover, but not full recovery. If you look at the loans that have been restructured, most of them are in these areas. Manufacturing was very, very little. They don't lend to the agricultural sector anyway. And I'm sure most of them are hitting themselves in the head because that's the sector that is actually performing well. So on a fundamental basis, you're not going to receive value this year or next year. Then you enter into an election year where everyone just things generally slow down.
They do, and they start slowing down a year before, actually, about 18, 12 months before.
Exactly, and you already have a contracting economy.
So then what are you telling us to do? Because we are going into the polls sometime in August. 18 years starts January of 2021, and we are in the month of October 2020.
So if you're investing for post-2022, where you start getting your, unless you're going into it for technical purposes, where you're just trying to trade the charts, where timing is now important, when to buy, when to sell, and churning your portfolio as much as possible, then yes, you will continue making money. Safaricom drops to 28 shillings, you sell it at 30, 31, that's 10-12% return right there.
Yes.
So if you're going to start becoming an active trader, yes. But then with the costs, again, Kenya is a double-edged sword. They increased brokerage fee by putting VAT on it.
Yes.
Your brokerage fee as a retail investor is already high.
It's about 2-3%.
2-3% one way.
So
buy, sell, that's 6%. Plus the VAT, we're not looking around 4.5%. So even if I make 10% on Safaricom, in essence, I've only made 3%. Inflation is 4 or 5%. It's as good as I've just kept my money underneath the mattress. There's nothing. That's you'll have done. Unless you're going to churn that portfolio and make 600-700% a year. For you to cover
in Kenya now.
For you to cover the transaction costs.
Fair
so in terms of bank profitability, it will definitely suffer coming into to quarter 3. If for all intents and purposes, if you look at their balance and where they are supposed to earn, and then if you look at their income statements, their expenses they have to incur to earn that, then I do not expect growth.
Okay, that's fair enough. And I think also when you also look at the market and the sentiment, I think there will suddenly be an interpretation of this GDP numbers. So in a way, we are saying as we go to the end of the year, typically there's much less demand for stocks towards the end of the year. Then secondly, some of these macro indicators tend to define investor sentiment. And also based on what we are discussing, what you're giving us insights on the banking sector, the earnings pool is not necessarily growing, which reduces the amount of dividends that could be possibly available to investors for another year or 2 years, then this bank's trading at 37, 35, they will come back down in one way or the other. It's just possibly a matter of time.
Definitely.
So then again, if you're saying I'm going for the long term, then don't buy them now, just wait.
Yeah, ideally, timing becomes key. But if it is long-term investing and you believe I'm looking at a period of 4 to 5 years, timing becomes pretty much
neither here
or there.
Fair enough.
But if you have a shorter term horizon, then timing becomes very, very important. But one thing also to look at when you're looking at bank financials to see whether you want to actually buy into a bank or not is to actually look at the off-balance sheet items. I know most of the times people don't look at off-balance sheet items, but if you look at off-balance sheet items, for example, ABSA have off-balance sheet items of close to 120, 130 billion.
That's a lot.
In
a lot of
forwards, swaps, and all those other things. And if you are genuinely looking at the banking sector, then you need to look at what is the interest rate sensitivity of those instruments they're holding. Are they held locally? Are they held internationally? What impact did the KES have on that? Because these are off balance sheet items. You won't find them on the balance sheet, but you find them on the disclosures.
So there's need to just be a bit more thorough in your own fundamental analysis.
Exactly.
Okay. Now, when I'm coming to the tail end of this show, we're saying there is value for the long term, but the value is selective. Now, when it comes to valuation, the key parameter you're looking at is the price to book ratio for the banks. If we go by the trailing numbers, we've seen banks such as Equity come to 1.2, This is a bank that used to trade at 2.8 times price to book. So relatively speaking, it's cheaper now than it was a while back. You're seeing KCB, it's actually trading at a discount to its trailing book. It's at 0.9. And most of the banks are closer to the 1 shilling mark. So they're trading at or near the book value. Earlier, you said that there's a bit of a balance when you're trying to value a company. Because number one, not a company, the banks. You're trying to look at the earnings and extrapolate the earnings. It's not very clear, and especially because of the non-performing loans statement and the inclusion of IFRS 9. If I go the harsh IFRS 9 way, I might miss a point, because globally there has been leniency from the accounting body in terms of how to apply this particular standard. Then secondly, we're saying the same banks cannot pay dividends, or we don't know when they'll pay dividends, and they actually do need concurrence from the Central Bank of Kenya. So how am I deciding an entry price point if I want to buy the Kenyan banks for the long haul?
So if you're looking at the price to book, the question is, as I mentioned earlier, because of not following IFRS 9, book values are very suspect right now.
Okay.
So you may think this stock is cheap, but if you apply IFRS 9, you might realize, oh, this is actually still at three.
So then put a premium. Put a premium. So
you'll still be like three times book, three times book value. But again, as if you're valuing based on cash flow, whether it's dividend or capital growth, but ideally you'd expect the bank to generate revenue which they will rather pay out, or it will reflect in the price. So you're looking at what then are the parameters as an investor that affect the cash flow of a bank. Number one is the general economy. If an economy is doing well, there's also demand, because a bank makes more money loaning out than giving to the government. Banks will normally loan out when the economy is doing well, because there's an increase in demand for loanable funds. But if the economy is not doing well, there's also a decrease in demand for loanable funds, and also the banks will be more risk averse. So most people put their money in the bank. Yeah. So that if you're looking at that element, we are saying that element is pointing towards a reduction in cash flow. Okay. What else affects a bank's cash flow? You look at the risk-free rate. Yeah, and in this case, it's generally government securities and all. That kind of favors them in a way, because that means their cost of funding also kind of reduces.
And there's actually a lot of liquidity, because even the interbank has come down to about 2.3, 2.2%.
Exactly. So their cost of funding reduces. But because of not lending out to the private sector and lending out to the government, the source that was supposed to benefit them starts eating them, because they start also getting lower returns. So on a 50-50 basis, that also pointing down reduced cash flow. If you look at management ability, do we have the managers in the banks who are able to manage the banks well? Because when you're managing a bank, you're looking at managing liquidity, managing interest rate risk, managing credit risk, managing market risk. Okay. Yeah. And if you want to try and evaluate those four and say who is doing good, who is doing better. So if you look at all of the return on assets for the banks, they've all dropped. Yes. From the quarter. But that shows you how management are using the assets to actually generate return. If you then now factor in interest expense and non-interest expense, then you realize return on equity has also dropped for all of the banks. As expected. So as an investor evaluating a bank, if you evaluate it from this point going forward, then you realize your price ideally will be very discounted from even the current market values that we are currently seeing in the market. The market values have remained where they are because honestly, if you're not investing in the banks, in the Nairobi Stock Exchange, who else do you invest in? So all your pension... It's just the banks or the telcos. Exactly. Okay. And the telcos is only one. Okay. So it's actually only one. Yes, yeah. Right. So if you're a pension fund, you're an insurance company, there's a lot of demand on these stocks, not because there's actually value, but because, hey, I have to invest this money. I can't keep it in cash. I can't put all of it into fixed deposits. But so then, who risk it? Take it out there. Yeah, you just buy the banks and you hope that in good time they will start generating value. But you see that they will, because the thing is, in as much as there is some short, but you know, there's this term that I keep hearing, short-term tailwinds.
And the story has never changed for the banking sector. There's always a storm after a storm after a storm, but somehow they make money, because what you're saying is the long term, people will still need to do banking services. And if you look at the economy, as much as it has contracted, some of the things that you didn't stop doing, you didn't stop banking, you didn't stop moving money, you didn't stop talking, you didn't stop being on Wi-Fi, and you didn't stop transferring money via M-Pesa. So maybe that could be a gauge of saying, maybe that it doesn't make as much money now, but in the future there will be a recovery. But then the tail end question for me, probably the last one, is if you look at it in that sense, Reginald, are you seeing a situation where 2025, because you've told us to be long-term investors, so let's look at a 5-year horizon, 2025, do I still keep using the bank as a service, or do I just switch all my mobile payments onto a telco?
I think banks will still be relevant. You need banks in an economy for capital to move around.
Okay.
Because they aggregate, they get the savings, and they do the matching bit of it, which is very key. A telco doesn't do that matching bit. It still needs a bank. If you put your money on M-Pesa, it still needs to sit with a bank that actually makes sure that that money goes to the productive side of the economy. Unfortunately, our banks think the government is the productive side of the economy, so there's a lot of misallocation of capital, and that's why the country will not grow that much. Future for banks going forward, I think in terms of succession planning, in terms of their hiring and all, will definitely change from currently what they've been doing. I think most banks now are thinking digital going to the future, moving brick and mortar, which will define what they hire, who they hire, and where they're going to be spending their money from. So there's going to be a lot of change internally, even in the banking sector, on how they look at their business. And even from an investor's perspective, when you are valuing banks, those are the things that you're going to start looking at. Right now you'll put liquidity or illiquidity discount or premium on your valuation. I think this time you'll be looking at a brick and mortar premium. So if a bank is more brick and mortar than digital, you'd actually request a higher discount rate for that. So there are a lot of things that will change even in the valuation. So if you continue valuing banks in a traditional way, and even banks, if they continue planning their strategy, their hiring and everything in a traditional way, then by 2025, fintechs will take over.
Okay, fantastic. Yeah. Thank you so much for that. That's all the time that we had today. So the final question that we want to ask Reginald, what's your parting shot? So yes, we're looking at the long term. KCB is trading at 37. Equity Bank came off. It's now at 35. I think we have Cooperative about 11.9 shillings. Barclays is Absa rather is 9.8. I mean, when you're looking at these banks, are there some that stand out for you in terms of if you're going long term and you must look at the banking sector, 1, 2, 3 has to be in your portfolio?
I'll put KCB. Say that they bank the government, they bank the parastatals after especially getting NBK. So long term, when they start churning the synergies of banking, government and parastatal, they will be a good buy going forward. And then their asset mix is also good in terms of where their loans are, and also being slightly bit more on the personal and retail side will augur well for them going forward. With the central bank coming in to try and regulate digital lenders, if they are going to be fair to that space, then Mshwari and all those other guys are also digital lenders and should then follow under the same regulations that they're going to bring. Okay. So I think the hawkish rates and profiteering they've been making on Fuliza and Mshwari will not last for that long if Governor Njorega remains true to his word. So I would say if NCBA will start a growth stock going forward, but KCB definitely. Equity, I think, as long as they can keep on getting cheap in the name of to forward lend to SMEs, this 1%, 0.5% loans, truth of the matter is that is what made equity grow. The ability to get very cheap cost of funding, then lending it at ridiculous rates to people. So if they can continue getting that, and I can see they tag along with the president everywhere and end up getting some cheap funding, then equity will be a good bank. Cooperative, their classification being putting that aside, again, also have a strong customer base in the cooperative movements and all, so they will definitely be a big bank, a good bank.
Okay.
And finally, Diamond Trust Bank.
Tell us about, because Diamond Trust Bank, many questions there.
Yeah, many questions, but if you then look at their fundamentals, if you look at their balance sheet, if you look at their return on assets, if you look at their return on equity, they've actually been performing well.
Okay.
Yes, they had taken a bit of risk when they went partnered with Nakumat and all those things, but I think that's in the past, and it's good lessons for them to actually learn. Going into the future, they are actually a good and strong bank.
Have you looked at their capital base? Do they have a strong capital base?
When you start going to capital, then you are bringing every other bank into the discussion.
So it's something to look out for.
Yes.
Okay,
yes.
Fantastic. Thank you so much. And that was Mr. Reginald Kazutu, who is an economist, and he was taking us through the outlook for the banking sector. Before we touch on the banking sector, the breaking news for the financial sector this afternoon is second quarter 2020 GDP numbers that are out. We have seen a contraction, the first at least I have ever seen, with GDP down 5.7 percentage points for the quarter ended June 2020. Of course, for the informal sector, the impact could be materially higher than what we are seeing. Reginald has given us an overview of this perspective, and I think the key point at this time is possibly that could have been the worst quarter, but the point of caution is you have a government that has been making decisions on the premise that the country would grow. Now the numbers are out, the economy didn't grow in that particular season. So then there's a question and an opportunity to look out and see what will be the government response. Of course, we don't expect any reactions because this is only one quarter. Second thing Reginald was talking to us about today was the banking sector. We have come to the end of the third quarter, and we expect the Tier 1 numbers to start announcing their results towards the tail end of October. We have looked at their earnings growth as well as the cost outlay to understand what is the impact that we expect for the subsequent months. And what Reginald is telling us is once a bank restructures its funding, then the possibility of income growth is muted, and the pool that income comes from becomes considerably lower than it was in a previous period. He's also told us that the expenses remain more or less flat with the inclusion of loan loss provisions, then that actually takes a huge jump. In other words, if you are looking out for a dividend from the banking stocks, highly unlikely that you'll get anything at least for a year or 2 years, also given the fact that we are going into an election cycle. In sum, he has told us that yes, these are the risk factors, but if you want to be in any sector in this economy, you probably do telecoms or banking, and there's some good names that you should look out for the long term. KCB, Equity Bank, and interestingly, Diamond Trust Bank. That's DTK. That's all we had for you today. We look forward to seeing you tomorrow, Friday. Ask Me There. We want to hear your questions. Please reach out to us, and we will look forward to engage with you then. Have a good afternoon.